let's look at the S&P 500. So first off, read this disclaimer carefully. Then do your good deed of today by liking and subscribing. So the S&P is 14% from the 52-week low, and around 14% away here from the 52-week highs. Here is the chart, weekly data points, and when we go very far back, we can see that ever since the low of the global financial crisis in 2009, we did see a very spectacular rally. So we are still very 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 far away from those lows, to be sure. The thing is that we have recently seen a very interesting move. So if we look historically at the S&P 500, you see here that the blue 100-week moving average, it's a very big deal. Big deal here as resistance and as support. So it obviously matters here. It becomes a battle zone. When support is back, then we see a very substantial rally. Here it becomes a battle zone again, and resistance at the 100-week moving average is very shortable. When it becomes support, it is very buyable. So throughout the history of this ETF, this moving average has been a very big deal. You also see here during the C19 lockdown. So let me just draw it in. It was very clear resistance here with these red arrows, but when we breached it, then the bulls got into action in a pretty big way. The reason why I highlighted that moving average is because we do have that one in action at the moment. So we are now breaking out above it. The problem for the bulls is that we did break out above that same moving average back here without much success. So the key thing is that we need follow through. So currently we just have a bit of a breakout that is sort of a bit guilty until proven innocent, for the simple fact that the most recent time the same thing happened, we did not see that the bulls followed through. What makes the current breakout even more interesting is that we have recently battled this purple 20-week moving average. It's been a very clear resistance level, very easy for the bears to short, but then again, we are breaching it. We are currently above it. That is a bullish sign. So there is some progress here. If we go here to the daily data points, interestingly, the blue 100-day moving average is a level that we have struggled with back here. A bit of an attempted breakout that certainly did not work out. So because of that, on the one hand, yes, getting above the 100-day moving average is a bullish sign. Then again, the issue for the bulls is that when we look at the history of this moving average, which investors will do, they will see that, well, it didn't really work out here. Meaning it was beneficial to be a bull before the attempted breakout. If you bought the breakout itself, it was a way more difficult trade. So the S&P is, in that sense, in a very messy situation. On the one hand, you do have a bullish move. Then again, historically, at least recent history, it hasn't really panned out. Looking here at these other indicators on the weekly SMACD, we do have a bullish crossover here that is beneficial. Some bullish action here on accumulation distribution. When we go here to the daily data points, accumulation distribution is very strong, so buyers are definitively in control. Looking at RSI, here again, the issue is that yes, we have seen improvement, but we are literally at the same level that formed this high back in March of this year. Same thing here with the 20-day and the 50 daily moving average PPL. We are literally at a level that has triggered previous pullbacks. So in my notes, I write 100 VMA breakout or fake out. On the technicals, I do give the bulls a 2 here because they are doing something that is more interesting than what they have done not that far back. The problem is that they are really in this all-in situation. They really have to deliver at this point. So yeah. I guess we have to look at some other data to get a clearer image of what is most likely to happen. So let's go to seasonality. So here is the seasonality data we get to the right here over the last 5 years. We do see that the seasonality is overall it's a bit bullish, but we do tend to see it's a lot of up and down. In blue here over the last 7 years, we do see that seasonality is overall a bit weak leading into the 1st of September. In red here over the last 10 years, then generally speaking, the seasonality is bullish. To the left, we do see that July, the current month that is ending, it is very bullish. August, which will begin next week, it closes higher 75% of the time, which is bullish, but September and October are some of the weakest months. Over the last 10 years, going from July to August and September, you do see that the seasonality deteriorates. Over the last 20 years, we do see something similar. The thing is that August, it does close higher 68% of the time, which is a decent number. September, it is a weaker month. October is a bit messy, so I think I will give the bulls a 2 on seasonality as well. There are some bullish aspects of August. The problem is September and also October can be weak, which means that given that we currently have a situation for the S&P where we really need the bulls to show a lot of confidence, the weak seasonality around the corner might weaken their resolve. Let's look at the fundamentals. So I am comparing the S&P 500 with the total world stock market ETF. Looking at year-to-date returns, we do see that the S&P is slightly outperforming by around barely. But anyway, outperformance is outperformance. Looking at beta, beta is a bit lower here for the total stock market. The price earnings is substantially lower, so when it comes to world stocks, you get better value. The dividend yield is also a bit higher, 1.6 versus 1.2. So let's look here at the holdings. Some of the mega caps will definitively repeat across these two ETFs, but 506 holdings versus 9,325. So here's the sector breakdown. More even spread here in the VT. And here you can see the market cap as well. And you see that even though this is a total stock market ETF, it is very heavily tilted, 62% to America and 55% United States. I do end up with a -1 here in favor of the bears on the fundamentals. Let's now look at statistical correlations. So long term, we do have a perfect correlation with the S&P 500. That is not a huge shocker. We have 98% here with VT, which is very strong. -26% with the dollar index, and 39% here with the 10-year yield. Looking at the daily data points, we do see that there's a perfect correlation with S&P 500. 99% here with VT, which is very, very close to perfect. -88% actually with the dollar index, and -82% here with the 10-year yield. But yeah, what happens with the VT is very likely going to affect the S&P 500. Let's look at the total stock market ETF, weekly data points, and in this case as well, we have seen this counter trend rally in the sense that we have a primary downtrend, and within that we have had a pretty strong rally. The problem is that we have seen these rallies before not really work out. They become these bounces without enough follow through. We have this bullish sign here on the MACD, similar to what we saw on the S&P 500. So that is definitively interesting. Looking at the daily data points, the accumulation distribution is definitively corroborating the rally. On the RSI here, we actually do have a bit of a breakout on RSI. So if you look here back at this fail level, we have actually been able to get above it. Looking at the 20-day and also the 50-day PPOs, we are currently at a previous counter trend fail level. Here is the relationship between the S&P 500 and the total stock market ETF. And you can see that ever since late 2009, the S&P has, pretty systematically outperformed the total stock market. We do see that we recently have a breakout here, a new all-time high in this relationship. So that is definitively favorable to the S&P 500. Looking at the RSI, we are not currently at a high level that is typical. That is a typical fail level for this pair, so the S&P could still run further upwards. You could make a bit of a case here, so let me just draw that in. That we do have a bit of a messy inverse head and shoulders pattern here, which is, a bullish technical pattern that could be further favorable here for the S&P. Looking at the seasonality here, so in green over the last 5 years, somewhat bullish here for the S&P. In blue over the last 7 years, also bullish seasonality. And in red over the last 10 years, we do see that the seasonality favors the S&P over the WT. So I give the bulls a 5 here on relative performance. So we do end up with a 1.8 in favor of the bulls. And the issue is that, yes, we do have breakouts on the 100 weekly moving average and also the 20 weekly moving average for the S&P 500. The problem is that we have seen these same breakouts be fake outs not too far back. We do, however, have some interesting seasonality and relative performance data that increases the probability that we will see a more continued rally. The issue, however, is that we do have the confirmation that the US has entered a recession, so it's definitively it's not, the best context, for a major rally. We have some time left, so let's look at some other, major country ETFs. So here is the FXI. This is the Chinese stock market. We have seen a pullback back to this horizontal support level. So I think that looking long term, this is definitively an interesting bullish level for China. But the Chinese stock market is definitively one where you need to be way better on your timing than other markets, simply because it moves in these very clear up and down waves. So even though we have had a global bull market since 2009, China has had multiple bull and bear markets within, which makes it highly tradable but can be very frustrating. Let's look at EVU, which is the previous major empire of the world, United Kingdom. So in this case, we do see these time cycles. We do have these general major time cycles here, certainly a bit disrupted by the C19 lockdown, but you see that there definitely is some kind of pattern here. The major key, super key level for United Kingdom is this red 200-week moving average. Clear resistance, resistance, support, resistance, resistance. The bulls try to make it support, then it becomes resistance. The interesting thing is that you had 1, 2, 3, 4 weeks of that moving average being resistance before the C19 lockdown. So if you just purely traded on the technicals, you would have avoided that plunge. So that is definitively very valuable information. Here, 200 week becomes support, support, support. But now this week it became surgical resistance. So yeah, we have now done a deep dive analysis on the S&P 500 and done some quick technical analysis of other markets. Overall, there's interesting opportunities out there, but we are in a very messy context. So definitively a time to have some tighter stops on positions and to be as market neutral as possible.